Good afternoon. Welcome to our Financial Advisor Forum. I'm Greg Greenberg from the Street. The S&P 500 has gained 27% so far this year, the ninth best January through November performance since 1945. So does that mean investors should lock in their gains and take December off? Sam Stovall, Chief Equity Strategist at S&P Capital IQ, is here to offer some historical perspective. Welcome, Sam.
Thank you, Greg.
It's good to have you. Please tell me, should investors sell in November and go away?
Well, if history repeats itself, and there's no guarantee it will, momentum will probably carry into December. What I found going back to World War II was that there were 21 times in which we had a very strong year-to-date period through the end of November, and in 71% of the time, the market continued to rise, and the average increase was a little more than 2%. So if you look to probabilities, it would say, let your money ride rather than try to take the money and run.
And which sectors generally do the best in December after a strong 11 months?
Well, what I did was I looked back to 1990, which is as far back as S&P Dow Jones Indices has data on sectors within the 500, and I found that those sectors with the best frequency of continuing their advance, if they were up more than 15% through the end of November, were utilities and consumer staples up 100% of the time, and then consumer discretionary stocks up 90% of the time. So the gains were pretty good, average of 1.3% up to about 5.5% on average for anything as weak as energy up to consumer staples. So in general, if you made it into those ranks where you were looking at a 15% gain or better, chances are you did well in December.
And if the year finishes out up 30% in the S&P, what does that mean for 2014?
Well, again, history says you have something to look forward to, that good years tend to follow great years, that whenever we were up by 20% or more, in the following year we were up an average of 10% versus about 8.5% for all years, and the frequency of advance was near 80% versus the more normal 70%. So unlike what most people would say, again, you want to bail out on a very strong year, no, the momentum tends to carry into the new year.
Well, that's the good news. One disturbing chart that's being passed around Wall Street trading desks right now is one that matches up the S&P to what happened in 1929, where we saw essentially a crash. That's got a lot of people unnerved. Does it unnerve you?
Well, obviously, being a student of history and looking at patterns, yes, I want to take a look at it more closely. Obviously, the questions that I would have are we looking at margins that were at 90% back then, but certainly we're looking at fairly high margin debt today, but nowhere near where it was back in 1929. Also, people question whether we're in a bubble right now. If you define a bubble like we did in the latter part of the 1990s, where we convinced ourselves stocks were still worth buying, even though the PE on the S&P on forward earnings was at 30 times, well, then I would say no, because whether you looked at trailing or projected earnings, we are trading at a slight single-digit discount to our median over at least the past quarter century.
All right, so hold on to those stocks heading into December. Thank you, Sam. And thank
My
you
pleasure.
all for watching the Street's Financial Advisor Forum. From New York, I'm Greg Greenberg.